We'll be getting started in just a few seconds, guys. Just waiting for everybody to assemble. I can see everyone joining the webinar. We'll be just kicking off in just a moment. Well, good morning and welcome to the Experian Quarterly Business Credit Review for Q1 2021. My name's Gary Stockton and we'll be getting underway here in just a second. If you'd like to download the slides from today's session, we've dropped a PDF in the download section. We'll also follow up with a link to the slides and a link to the recording after the webinar. If you'd like to share that with colleagues, by all means, go ahead and do that. Today, we're going to be discussing the key findings from the Experian Moody's Analytics Main Street report for Q1 2021. And the review is going to be presented in 3 segments. Presenting for Experian is Brody Oldham. He's the Senior Director of Analytics Consultancy. And presenting from Moody's Analytics is Christian Doridis. He's the Deputy Chief Economist. And joining Christian is Derek Grunfelder-McCrank, an economist with Moody's Analytics. Now, to make sure you get the most out of today's session and getting the answers to those questions that you have, and there's a lot going on in the economy, we encourage you to raise your hand by submitting your questions using the question tool. You should see there in the GoToWebinar applet. And if there's time at the end, we've got a full session today, but if there's time, we will respond to those questions. If we can't get to your questions, one of our panelists will follow up with you. And now I'd like to hand things over to Christian. Let me just pass mouse control to you.
Excellent. Very good. Well, thank you very much, Gary. Welcome everyone to our quarterly session. I always look forward to these webinars. Small business, of course, is very important to the U.S. economy as a whole. Also holds a very special place in my heart. So clearly enjoy learning about the small business environment, studying the current credit conditions, and understanding where small businesses may be headed. So today, my job is relatively easy. I'm going to be providing the economic outlook and really setting the stage for Derek and Brody to dive deeper into small business conditions, really talk about some of the credit trends and other data that we're seeing in terms of how small businesses are faring. My slides here are going to be broken out into really 3 main parts. And the first part, I'm going to talk about some of the current trends that we're seeing in the U.S. economy. What are some of the things that are going right, some of the things that are lagging. From there, I'll talk about, or I will provide the Moody's forecast. Where do we see things headed based on current conditions as well as econometric models? And then finally, I'll highlight a couple of the key risks to the economy overall and paying special attention to small businesses and small business credit. I do look forward to your questions at the end, so do feel free to use the chat function as Gary mentioned to enter those questions, and we will certainly try to get to as many of those at the end as possible. Otherwise, I'll certainly follow up with any questions that you might have. Okay, so with that, let me dive right in to my first slide here. There we go. And the first thing to note about the U.S. economy is that it is in full recovery mode. And we can see that very clearly based on our back to business, or back to normal index, rather. This is an index that we have developed jointly with CNN Business, which essentially combines a number of real-time economic indicators, right? So we're trying to look for non-traditional alternative data to give us more of a real-time read on how business conditions are faring compared to relying solely on some of the government data, which is great, but may be collected with a lag. So this back to normal index combines information including data on smartphone mobility, so data from Google and Apple, and let us know how consumers are moving about the country. Are they going back to their workplaces? Are they going to retail areas? Are they going to parks and recreation areas? Right, so there's a wealth of information we can gather just from understanding where people are going with their smartphones. We combine that with information from the TSA on airport checkpoints. We can see how many airline travelers there are in any given week and compare that to, say, a month ago or even a year ago, and get an understanding of how airline travel is faring. And again, that gives us some insight into how consumers are responding in this current environment. We have information on restaurant reservations from OpenTable, right? So it gives us a sense of how quickly things are opening back up. We also include data from Homebase, which is an online platform that caters specifically to small businesses, and that can give us some indication of small business activity, workplace or workforce re-engagement. And so the combination of all these factors leads to an index that you see here. And the beauty of this index is not only that we can see how things are faring in real time, but we can also break up this data geographically. So key thing to note in the chart here is that the economy is recovering. We are getting back to normal as a nation. We're about 90% of the way relative to where we were back in February of 2020 when the pandemic began. But some states are doing better than others. So Florida is leading the way. By our calculation, 100% back to where they were in terms of consumer activity. You can see that by the green line. So Florida has really been on the leading edge in terms of reopening and really getting their economy moving once again. The laggard is New York State, of course, ground zero for the pandemic itself, has been struggling a bit more certainly to reopen. But now we are starting to see things accelerate, and our expectation is that certainly by the end of the summer, we will see most, if not all, states back to the level of activity that they had going into the pandemic. So things are clearly moving in the right direction. We're not quite back to where we were before the pandemic, but we're getting there awfully fast. Now, if we take a look at economic growth overall as measured by inflation-adjusted GDP, what we can see is that the economy is certainly booming by this metric as well. So here you're looking at a variety of scenarios that we run at Moody's Analytics for the growth rate of GDP for 2021, 2022, and beyond. For the second quarter of 2021, you can see we're expecting this 13% year-over-year growth rate, so an astronomical amount of growth, but that is really driven by base effects, the so-called base effects. The fact that 2020 Q2 was so weak means that any type of growth in 2021 Q2 is going to be accentuated. So it's nice to see this pop here after the sharp decline last year, but it doesn't really give us a full picture of what's going on. Better to look at the growth rate or projected growth rate out a few quarters. And so what you can see in the chart is that for the end of 2020, or for all of 2021, I should say, we expect to see GDP growth for around 6.5%, right? So very, very strong relative to history. Prior to the pandemic, we were growing just around a 2% growth rate, as you can see here. We expect that growth to continue even into 2022, seeing still a 4.5% growth rate, really driven by a lot of pent-up demand that's out there, as well as all the government support between fiscal policy and monetary policy. So there's going to be quite a bit of spending, investing that goes on over the next couple of years, and that's going to push the economy forward. That said, there is still uncertainty, as always, around the economic outlook. And so you can see some of our alternative scenarios, both upside and downside scenarios, illustrated on the chart here. Things could go much better when it comes to vaccinations and reopening the economy and really re-engaging with businesses and consumers. So we do see some scenarios that show some upside risk. Of course, there are downside risks as well, right? We could see another wave of the pandemic. We could see slowdowns in the rest of the globe, translating to slower growth in the US as well. So for that reason, we run a variety of scenarios. But under the baseline, you can see that the outlook is quite positive. Now, a main reason for that positivity has to be the resolution of the pandemic itself, right? We are seeing vaccination rates continue to rise, right? After a bit of a slow start, we've really accelerated vaccination speeds beyond what we thought was possible earlier in the year. So with well over half the population vaccinated, or at least of adults vaccinated, we are in good shape, certainly leading much of the Western world. And we see the result of that from falling case counts. By my last read, we have about 14,000 new confirmed cases of COVID-19 on average on a daily basis, and that's certainly a very steep improvement from the 250,000 cases or so we had back in January. So things are clearly moving in the right direction for the pandemic. We need that momentum to continue. By our estimates, by Independence Day, by the 4th of July, we should have close to 65% of the adult population vaccinated or having had a previous infection. And that will carry us forward in terms of consumer confidence and additional spending. People are just going to feel a lot more comfortable once we hit those benchmarks to re-engage fully with the economy. On the map here, though, you do see that there's some variation across different states in terms of the vaccination speeds, and that does have some bearing in terms of confidence and the recovery. But what we are seeing is less and less so. As people are getting more and more comfortable across the board, the levels of COVID infections are so low that people are feeling quite comfortable to go out, either with a mask or without a mask, and re-engage with the economy. Now, the one area that perhaps is a bit of a mystery or hasn't recovered as quickly as we might like, although it has recovered faster than history or prior recessions, is the labor market itself. So on the chart here, I'm showing the total number of unemployed individuals. So these are shown in green, the number of people who are not currently employed and actively looking for work. They say that they are willing and able to work at the moment. You can see that number is right around 9.5 million or so. What is interesting is that at the same time, we just got a number within the last hour or so for the total number of job openings in the country as of April, and that's right around 9.3 million at the moment. So that gap between the number of unemployed and the number of job openings is small, and that is quite unusual in a recession, certainly, or even coming out of recession in the early stages of a recovery. You can see on the chart here, if you look back at 2009, at that point in time, we saw quite a gap, which is typical between the number of unemployed and the number of job openings. So there are lots of job openings out there. Employers are anxious and continuing to hang their help wanted signs, but thus far we haven't seen that tremendous take up in employment that we otherwise might expect, given this 9.5 million unemployed. Now, there are lots of reasons for this that I'll touch on in a moment, but before we do, I thought it would be a good place for a poll. And so, Gary, if you wouldn't mind opening up a poll question around the primary reason why you believe people aren't filling these open positions. So specifically, why aren't unemployed individuals going out and filling all of the open positions that are out there? And as I mentioned, there are multiple reasons. I've listed some of them here, and I give you an option for other at the bottom. And so I'm asking you to select one. What do you think is the primary reason? Obviously, there may be multiple reasons for any individual. Okay, so I'll give you a few seconds here. Gary, let me know when the poll is ready. Okay, yeah, so primary reason, about 63% of the population or the audience here identified that unemployment insurance benefits exceed offered wages. And that certainly is one of the leading reasons given for why unemployed individuals aren't re-engaging with the labor market, or certainly delaying their re-entry. We had some other reasons on there as well, including fear of COVID and childcare issues. From my perspective, I think all of these are intertwined and interrelated, so it's actually a little bit difficult to disentangle, right? So you might have childcare issues which make it difficult for you to re-engage with the labor market, but the fact that you have unemployment benefits may allow you or buy you some time. So it's unclear whether it's the benefit that's maybe keeping you out of the labor market, or if it is these difficulties with childcare, or concerns about contracting COVID, either for yourself or your family. But clearly, UI benefits is a growing concern, And you have a number of states now, about half the states have indicated that they will be discontinuing the expanded unemployment insurance benefits, the extra $300 that individuals have been receiving, as a way to ideally incent people to come back into the labor market. The jury is still out whether this is going to be a successful program or not. It's not clear, right? There isn't hard data to suggest why people are not taking a job. So this will be, in some sense, an experiment. We'll learn something about behavior. But I think ultimately the trend is quite positive. So we might not agree with the speed of it. We might want things to move a little bit faster, people coming back in the labor market to take all the jobs that are out there. Certainly businesses are screaming that they can't find enough labor. But if we look at the trends in employment and we look at the trends in unemployment insurance claims, they are positive. You see that the unemployment insurance claims, initial unemployment insurance claims, have been trending down. That's the blue line on the slide here with the right-hand side axis. As of the last week, there were 385,000 people who applied for those UI benefits for the first time. That's still high by historical standards, but a far cry from the 6 million or so that we had early on in the pandemic. So things are clearly trending in the right direction. We are hiring. We're hiring more. Last month, we added over 550,000 individuals to the payrolls. And many of those jobs were actually in the leisure hospitality industry. So jobs that are associated with lower wages, not the jobs you would expect to be filled if in fact UI benefits were really, or generous UI benefits were the main reason for people staying out of the labor force. So I think, again, we'll get some more data over the next few months. We'll have some experiments going on here. But overall, the good news is things are moving in the right direction. My expectation is that by September, these programs, the UI benefit programs will have expired, schools will be reopening. So all of the factors that we are identifying as issues in the labor market should have been resolved. And we should be in full swing in terms of true labor market recovery and more general economic recovery. So things are clearly moving in the right direction, just perhaps a bit more delayed than we otherwise might like. But I do think it is important to keep in mind that relative to other recessions, we are recovering much, much faster than we have in previous episodes. So we're clearly on the right track. Now, another data point I would indicate or present to you as a positive, but also one that might be leading to some of that delay in re-engaging with the labor market, is the fact that savings among households are at all-time highs as well. By our calculations, there are $2.5 trillion in excess savings, right? So this is a calculation of how many savings households would have had we not had the pandemic. We were just going along the 2019 trends that we observed. And as you can see in the chart here, it's a lot of pent-up demand that's represented by those savings. Much of it is certainly in the higher income households, as you can see here. So a predominant amount of those savings are held in liquid form in checking accounts, saving accounts, and predominantly in the upper half of the income distribution. However, even at the bottom, even if you look at the 0 to 19 percentile, right, the first fifth of the income distribution, even that population does have more savings today than they had in 2019 Q4. So that too may be a reason why households may be delaying their reentry into the labor force. Might buy them some time to look for a better job. It may alleviate some of the concerns that they have. But again, at some point, these savings will also wear thin, and we will see more and more people entering in the labor market. All right. One other point to make as we think about small businesses is the trend that we're seeing in terms of bankruptcies. And so government support certainly has been beneficial to households in terms of their balance sheets, keeping delinquency rates low and propping up the savings that we just saw. The PPP program also has been helpful in limiting the number of bankruptcies among businesses, particularly among small businesses, as you can see here. So 2021 so far, we have relatively low number of bankruptcies so far to date. And annualizing the current pace would indicate that our bankruptcy level is probably going to come in somewhere close to what we had in 2019, right? So well within the norms. Not at all what we would expect in a very severe recession such as this. So that is some good news on the horizon as well. And as we look more generally at small businesses, we are encouraged by the number of new business formations that are occurring. The applications to start new businesses are at record highs as well. So clearly there are some very positive signals within the small business environment going forward. All right, I'll end with just two risks to the forecast here that I'd like to highlight. The first, I think, is one that is on most people's minds. Just as a consumer, I think you're well aware that the inflation is starting to creep up, and certainly a number of products. We can see that in everything from gas prices to any type of construction, lumber, copper, any type of commodity. We see a spike in prices, given all the demand that has been unleashed. Certainly housing is a prime example of a lot of demand forming among households with limited supply on the builder side, and that is pushing up prices across the board. You can see that also very clearly in the auto market, the used car market, given supply chain bottlenecks when it comes to the lack of chips to go into new cars. We can see that used car prices are through the roof in terms of their price acceleration over the last year. Now, our expectation, like the Fed, is that these price pressures are going to be transitory. So you can see on my chart here, I'm showing you a number of different inflation series. The headline PCE and the core PCE is actually what the Fed relies on for their understanding of inflation trends. And each index is a little bit different in terms of how it measures things and treats things such as medical premiums and whether medical procedures are covered by government or individuals, or how housing or rent is treated. So that's why you see some of the difference across the different indices. But by and large, you see very similar trends. We are expecting a spike, certainly to continue in the near term here over the next couple of quarters. But then by the end of the year, we should see a number of these supply chain issues dissipate. Right? As supply chains get restored, we should see that profit incentive lead to additional supply of goods, and that will take off some of the pressure that we see on prices at the moment. So longer term, you can see we do expect inflation to trend right around 2.25% going forward, right where the Federal Reserve would want it. As we get into 2023, our expectation is we would have reached full employment by then. Labor market would have fully healed. And at that point, the Fed is going to start to raise rates, and you can see that translating into higher 10-year Treasury yield. The risk here is that I'm wrong, that these price effects are permanent, that they get embedded in the psychology, and if that inflation should take off sooner than what I anticipate here, then the Fed would have to intervene. They would have to cool and put the brakes on the economy, and certainly that would be a negative to the outlook that I've presented so far. But I don't want to end on a down note. I'll end on an upside note. The productivity statistics that I've mentioned on previous quarterly webinars continue to impress. Right, we saw continued growth in productivity last month, or in the last read for the U.S. economy, and that is certainly a positive. If we are somehow able to sustain the productivity gains that we've managed to eke out during the pandemic, whether that's because we are leveraging remote work, so there's more flexibility, the cloud computing, the web meeting technology that we're looking at here, whether all of these productivity enhancing technologies allow us to keep these productivity gains, that would certainly be a positive, and it would remove much of the inflation concerns. Right, if we're able to do more with less, then that inflationary pressure should subside. It also means that we'll see faster growth in the U.S. economy overall, and wages would also rise as individuals are paid their marginal product. So I'm very hopeful that we will see some productivity growth sustained. It might not be at this 4% year-over-year level, but even if we are able to maintain 3% or even 2% for the foreseeable future, that would certainly be a positive. So with that, I'm going to stop and hand over the call to Derek to take us through some of the small business data.
All right, well, thank you, Chris. And I think I have mouse control. Apologies, I do have a bit of a lag in the when I change slides. So although you may see a change, it takes a second for me to see it. So there we go. So as Chris and Gary before him said, I'm Derek Grunfelder McCrank. I'm an economist at Moody's Analytics, and I'm going to start out the way that I always start these webinars, just by saying, thank you to our partners at Experian. The data that we are able to get from them and look at provides wonderful insights into what's going on in the small business credit space. And part of that is just because the breadth of the data that we do have in this data set and are able to look at and dive into. And I won't be able to touch on everything in our webinar today, since I have about 10 minutes here. But if you go to our Main Street report, we do have a more in-depth look at the small business, what's happening with small business credit there. And you can find that on the Main Street report site. All right, so to kick things off, delinquencies did tick up after their PPP-induced drop from 2020. It wasn't a big increase. It was only about 7 basis points, so going from 1.21% in the fourth quarter to 1.28% in the first quarter, and that's across businesses and regions. And I'll take a closer look at what's happening on a regional level later. And for an even more in-depth look at industries within regions, as I said, you can find that information in our report. So it looks like what's happening with this uptick in delinquencies this quarter was really more of a seasonal factor than anything else. So we saw that in line with prior first quarter changes, the outstanding balances for small business credit declined slightly in Q1 of 2021. And this has the effect of taking those delinquent balances and making them a slightly larger share of the overall small business credit space. So if it hadn't been for this seasonal factor coming in and affecting the numbers, we would have seen a pretty stagnant quarter. So overall, things are level in Q1. And again, part of that has to go with the enhanced relief measures that are in place. So whether it be forbearance options, extended terms that were put into place, refinancings that were done over the last year, what have you. It was a pretty quiet quarter overall. We did see that small businesses added some employees back in the first quarter. So the smallest firms that we look at, those with 1 to 19 employees, added a little over 100,000 workers back compared to Q1 of 2020. Although we're both the 1 to 19 and 20 to 49 employee groups are still down almost 2 million employees total between those groups. But we have seen that as business confidence measured using our MA Global Business Confidence Survey, as that metric has gone up, we have seen that businesses are adding back employees with reopenings, with herd resiliency coming into play. Businesses are adding people back. But I'm sure, as most of you have heard, there's the narrative that, small businesses are having a very tough time finding people, and businesses in general. So as you can see here from the NFIB report that was released last month, the number of businesses, specifically small businesses, reporting hard to fill job openings reached an all-time high. So 44% of respondents said that they currently have a tough to fill job opening. And one of the common narratives out there right now is wage inflation is preventing small employers from being able to compete with larger employers, which is a little contradicted if we look at the data. So the two areas that we would look at for small businesses reporting their primary concern to be, if that were true, would be the inflation and labor cost metrics, which, as you can see here, are actually two of the less important factors on the minds of small business owners when it comes to their primary concerns with their businesses. Right now, sales and taxes are more more important factors on their minds. So with some of the fiscal measures that have been proposed by the Biden administration and the potential for taxes increasing, we've noted that taxes have become are rising in their importance in the minds of small business owners. As you can see, poor sales, it spiked last year and since then has been coming down as Chris showed, states and localities are getting back to normal as per our metric of the back to normal index. So as reopenings are happening, as businesses can get customers in the door again instead of solely relying on their online channels, which small businesses may not have had built out as well going into the pandemic. But as people can go into stores again and do their shopping, small businesses have reported that poor sales is a less important factor in their minds for their primary concerns. But is an opinion survey really enough in order to say that small businesses, what's holding them back from hiring and getting back to their full employment? So wages is one of the more commonly talked about things. And here I've shown per the employment cost index from the Bureau of Labor Statistics, the change in private industry wages, specifically on a quarter over quarter and year over year basis. So in the first quarter, we saw this number spike up. So the quarter over quarter change was 1.1%, which annualized is a little over 4.5%, as you can see in the blue line here. So it's looking like all of a sudden people are refusing to go back to work without these large wage increases. But again, that's quarter over quarter. As people are finding jobs, they may be demanding slightly higher salaries, or they may be getting new jobs that have slightly higher salary and wage compensation than they did before they were furloughed or laid off, lost their jobs as a result of the pandemic, or went back to work as they felt comfortable that we're approaching herd resiliency. However, when we look at the year over year numbers in the orange line, we see that wage growth has been pretty steady over the last year or so. There was a little dip in 2020, but overall, we're still in that about 3% year over year range. So businesses are still, or private industries at least, are still increasing wages at a fairly constant pace compared to prior to the pandemic. So we haven't seen this massive wage growth or cost push inflation for small businesses that would make them less competitive. So we view this as a positive for small business credit going forward, that they aren't seeing these outrageous cost push wage inflation that has been brought up in some areas. So as I said, this is a positive for small businesses. They don't have that as their primary concern. It's not going to be holding them back from being able to make their payments, service their debts, and hopefully grow their businesses. So I think I have time for my one last slide here. So getting back into more of the meat of the small business credit data, looking at performance across regions, not industries. So using the moderate delinquency rate, which is 31 to 90 days past due, we see that across the country, most regions are looking pretty good. The Southeast and Northeast are standout performers in terms of their moderate delinquencies being low, with the Plains and Mideast regions being on the higher side comparatively. And this is a trend that it tends to hold pretty well over time. Occasionally, you'll see a region bounce around and switch from being the most delinquent compared to other regions to being the second most delinquent, or being the least delinquent to the second least delinquent. But overall, the regions tend to have fairly steady performance. And this held true in the first quarter, which, as I said earlier, was a pretty quiet quarter for small business credit. But it sets the stage well for positive performance on small business credit products going forward. So I think that's my time. Thank you all, and I will turn things over to Brody, who's going to talk a little more about what we see in depth in the small business credit data.
All right, thanks, Derek. Always
Thank
a
you.
pleasure to be with you, and fun to catch up with you as we get together every quarter, just to meet and talk about what's happening. And as we talked this morning, there's a lot going on, and it gets us excited. Gets us excited to see what's in store for us over the next few months. How excited we're going to be as we get into some of the new growth that we're going to see within the U.S. and really have an opportunity to get back to normal, get out there. And I will say, certainly for me, it has been getting back out. We've been out with our neighbors, masks optional in a lot of places. I'm here in Texas, so you still see a little bit off, a little bit on, but a lot more of that open commerce happening where folks are out shopping in person versus online. And so a bit of a change as we get into the rest of this year in 2021. So I like to start a bit with our consumers, because consumers really fuel what we have for small business performance. What you see here is just a few metrics as we look across the consumer outlook for the US. You'll see consumers are really out starting to shop. You saw Chris earlier present some information on that savings rate, that $2.5 trillion that's still out there in bank accounts being put away for a rainy day. Well, the rainy day's here. We see consumers really out starting to spend. We see our consumer credit card originations picking up pace back to where we were pre-pandemic for consumers. You'll see delinquencies are still low, very low, and trending downward across the U.S. A lot of that is held up by a bit of stimulus still, and it was alluded to in a few of the metrics that we saw earlier in the session today in our discussion. But you'll see those delinquency rates still pretty low. Now, if you look here, one of the things that we key in on during a pandemic is the modification activity and forbearance activity that's happening within some of the lending products on the consumer side. Remember, consumers are still small business owners, and so whatever is impacting a consumer will ultimately, for a small business, if they're using some of their small biz or their personal credit for small business activity, it's going to impact the amount of available credit for them to keep their business afloat or to move into that expansion mode. We see here down at the bottom that forbearance is leveling off, and really to a very low rate as we come into the end of May and into June. Very low as some of these programs begin to really taper off. You see it approaching a normal level for pre-pandemic as we go forward, and we'll see more of this forbearance activity drop off as we get into the fall of this year. Now, as we transition from our consumers into our consumer credit into commercial credit, I want to start with some installments, some more long-term type of products that you would evaluate if you're looking for small business health. And I think this is a good chart on the left because it really shows you the installment activity up until the PPP program early last summer, and then the PPP program that was enacted during the first quarter, some of that additional stimulus support that was given to small businesses. You'll see an uptick there. You'll see that balances, as we look across the average line for this type of installment term loan type of product for small businesses, you're going to see that it peaked right before the pandemic really took in full force. So businesses were out trying to get a hold of these loans, doing them at a higher dollar amount, prepping for the pandemic as it really rolled in March and April. But then the level dropped a bit, and that's a lot due to the stimulus program and the number of stimulus loans that were put out through the PPP program. A lot of those, I would say about 80% of those are under $100,000. So as you bring down the averages there, and a lot more of those loans are flooding into the market, that average loan amount certainly drops off. Now, one of the good things with the PPP loans, as we look at the information here and some of the analysis that we've done internally, is that about 70% of those have been forgiven to this point, according to the SBA. As we go forward, we're going to see really most of those, again, we're at that $100,000 level. Our lenders that partner with us are really very interested in what's going to happen in that next tier, that $100,000 to $150,000 mark for loan forgiveness, and that's really what they're focused on as the program really closes out. But that stimulus money is still out there helping small businesses to keep them up as we go through the summer. Now, on the right-hand side, what you'll see is the risk and underwriting. So this means private lending. So private lending has been squeezed a bit with the amount of government stimulus that's in the market. That's really free money that was given to small businesses. Private lending had a hard time competing with free. And so during this time, we saw a drop off in the amount of loans that were being originated by private lenders. That's starting to pick back up. We saw some tightening of credit criteria as the pandemic really initiated, but now that has really leveled out, certainly through the end of the year and into the first quarter, where we're seeing that the different tiers that are being originated have really stabilized, and so originations are happening across all risk tiers. Some of our larger lenders are certainly digging in to some of those more risky tiers a little bit deeper, using some advanced techniques to try to call out a few of those less risky small businesses, and looking for certainly across different industries, opportunities that they can dig a little deeper and continue to grow their portfolios, because portfolio loan growth has been pretty slow over the past year. Now, when we continue to look at installment loans here, what you'll see is something that Derek mentioned as well, is that really in general, we see our sloppy payers, early delinquencies on the left. These are your 1 to 30 day delinquencies. Means, they're paying a little late. They're just having trouble, from month to month. You see those are really, really very low compared to years past. And so coming into the next few months, our expectation is that those will stay low with the stimulus support that's out there at this point. We do see that, when we look at that median range that Derek spoke to, we see them again very low across all the U.S. We do see a tick up just a little bit in 60-day delinquency, that 60 to 90 bucket. That when we see these invert and cross, what it means is that more of those 30 days are transitioning into 60 days. But again, these are super low rates of delinquency at this point. So it's still something that we'll monitor, but at this point, it's not something to raise any flags. Now, when we look across industries, I always think this is important because different industries perform in different ways depending on supply chain challenges that they're having. If they're waiting on additional support, potentially from an infrastructure bill that's going to come this summer, we look at our public administration, within their portfolio, we see some uptick in 90-day past due year over year from last year in March. Again, waiting on some support from government stimulus will essentially raise this back up. Our retailers have been, if you look at the blue box in the middle, performing pretty well, and really have had a good bounce back during the pandemic. And once we're able to open up, we've got in-person shopping now. So we'll see these as wholesalers transition to retail, and pick back up. That supply chain opens up, as Chris alluded to a little bit earlier. We should see those delinquencies come down within the portfolios. And then construction. If you're building a house now, it's a difficult time because materials are, if you look at lumber alone, it's up almost 600% from what it was last year, just in sheer cost. I have a roofing buddy that said, boy, if I would have only known, I would have rented warehouse space and put a bunch of plywood in there, and would have been making money hand over fist. So it's a tough time. When we look at that construction industry, what we see is that some of the supply chain challenge that's happening across the industry is slowing down home sales. So the prices are higher at this point. You can reference the Case-Shiller Index, National Association of Realtors here, because that is so the supply chain is squeezed a bit. You're going to see houses being built a little bit slower. You'll see the price of those commodities to build a house come in a little bit harder to get. Some of the shelves are empty at your Home Depot or Lowe's. And so we see some of these slow down. That's going to impact our construction industry a bit as that supply chain tightens. What that's going to do is create some opportunities for some additional delinquency as we go forward. But we're hoping that as the supply chain opens back up, we get into the fall and we get back to where we should be normally, COVID in our supplier nations and here within the US kind of open back up, get that pipeline going, we should be in good shape to continue to accelerate these industries, and those delinquencies would continue to go down as we get into the last part of this year. Now, I do like to talk about unsecured debt as well. So credit cards are a good way to do that. When you look at the rebound in the credit card industry, certainly for commercial card, some of the large service providers and credit card originators, you'll see them really turn on the recessionary plan in April and May of last year. They looked for ways that they could get back out and offer those unsecured products. Remember, stimulus was offering free money over a period of time for these businesses to stay afloat. They didn't really need new credit cards. They weren't taking on new debt. They were a little concerned about how to save their business versus invest and grow. But what you'll see over the past few months is that the credit card industry has opened back up, and certainly for commercial card, a lot more lucrative offers going out to small business owners and consumers. Reward programs are being revamped. You're going to see a lot of that over the coming months, and we'll continue to see this rise in growth and originations as we continue forward through the end of the year. Underwriting, again, remaining pretty stable, but digging a little deeper here, you're going to see these blue and purple lines expand as we get into the second quarter, and that'll let you know that some of these lenders and providers are opening up their credit criteria to dig a little deeper to get into that growth early. You'll see marketing campaigns pick up. Your mailbox should be full as we go forward with marketing campaign material and offers, getting small business owners the help that they need as we come out and the economy really heats up. In credit card portfolios, you're going to see the same areas of interest that I pointed out before for term loans, but you're going to see them here as well. Now, we look at performance, so delinquency rates. As we go forward, you again see those 30-day delinquency rates trending down. We have a bit of an uptick in the Southwest as far as delinquency rates, a little more erratic. As Derek mentioned, you'll see some variability there, but we're seeing it in the Southwest. Now, overall, delinquency rates for the beyond 30 days, so not our sloppy payers, but a little bit beyond where they are having a little bit more difficulty, we still see those delinquency rates pretty low for an unsecured product. And our 60-day has not crossed over the line for 30 days. So that means that we're still maintaining a good balance between 30-day delinquency and 60, and it's not accelerating. So that's good to see. Now, one of the things that you're going to hear a lot of, and if you're reading the paper or watching the news, you're going to see a lot on cyber attacks and different ways that businesses are being infiltrated, certainly held hostage in some points. And we see that these incidents of fraud have picked up since the beginning of the pandemic. PPP had some real challenges as fraudsters were getting in there. If you have portfolios, you may have fraudulent businesses that came in and applied for these loans. If you weren't doing upfront fraud checks or identity checks, because we were trying to get those loans out quick, you may have not done that. You may have some of these fraudsters sitting there, bad actors sitting in your portfolio and ready to take advantage as we kind of loosen up and we look at cross-sell activity with those that are on book. So be careful of that as you go forward. Certainly some big incidents here that we've seen with JBS Meats and Colonial Pipeline. These cyber attacks are coming from third parties coming in and really hitting across supply chains. That could be a risk to us as we go forward for small businesses, cause some tightening across different suppliers. So we'll be careful as we go forward. Certainly could hit our construction industry as we're teetering a bit, and some challenges there as well. So looking for risk, certainly something to think about as you go forward, that as PPP comes to an end, those fraudsters are going to refocus on financial institutions and the products that are being offered there. Now, another thing to think about as we go forward is, we talked about delinquency levels being low. Now, I won't recap this as Christian or really talk to what we're seeing in bankruptcy trends. The trend is really shifting here from last year, where it was focused on some restructuring activity, into really those that are more illiquid. And so you're going to see a shift, but again, we're going to be at about normal levels this year as we were in 2019. So not expecting a big bump in bankruptcies, even as courts are fully reopened now and we're moving forward with some of those procedures. Now, pre-treatment strategies are important, certainly within our CEM partners, our energy providing partners, still dealing with some moratoriums around the country in different regions that are causing some challenges in allowing them to collect on businesses with less than 25 employees, and really looking at ways that they can evaluate whether those businesses are paying others and just not paying them. Do they have an opportunity to do some pre-treatment reach out for some payment plans as they go forward? So I think this is a good strategy to take, even if you're looking at your own business, you have different types of products, doing some of these pre-treatment strategies on accounts that have delinquencies that are still in that 30 to 60 day range as you go forward. Now, another thing that's been really in the narrative of this year, and is something that you can really take some action against in the coming years, set some goals, is within diversity and inclusion campaigns. And a lot of you have those on the books and putting money towards it. I think it's a great opportunity for us to engage the underbanked community, really bring a lot more folks in, give them an opportunity to gain access, separate their personal from their commercial credit profiles, and give them an opportunity to really build those up. That's going to help them to get funds for future development at a much lower cost. So really good stuff here. That's really our mission, to be your partner as you go forward. And really a few opportunities here that we can help you as you go forward. But it is one of those key points, key focus areas for a lot of us as we go forward. Now, when we kind of wrap this up, what we're going to see is, again, markets are broadly reopening. Chris touched on this. There's a lot of pent-up savings that's out there. We're going to look for ways to dig a little deeper, even those that have been a little troubled during the pandemic, giving them opportunities to reach out for products and dig a little deeper with lenders. So also, we're going to be shifting from small businesses looking for more private funding as we go forward versus the stimulus programs. And coming down as we look at what our customers are doing, they're really focused on customer experience and automation. We're going to see a lot more of that as our customers hold on to where they were during the pandemic, looking for those digital opportunities, engagement with small businesses. They're going to hold on to some of that. Even though they're in-person shopping, they're still looking for opportunities to engage online. Some of the risks that we're going to see are the end of stimulus and moratorium programs. Certainly another risk is in the mortgage market. As we get into the fall and some of those programs end, it's going to put some additional debt on consumers. That could also create a flooding of properties into the mortgage market, into the real estate market, which could lower prices, create some equity gaps for some customers as we go forward, and reduce some of that equity that they have available to hold up some of their small business. So there's some risk out there as we go along, but I think in general, we are on the way up in a heating up economy, and excited to see businesses move from survival into growth mode, and really looking to crush the new norm as we go forward. So Gary, do we have any questions that are out there that we can talk to today? Any questions that folks can put in?
We had a couple of things happen while you were speaking there, Brody. Both Derek and Christian lost power. We did get a few questions that came in. We are almost at the top of the hour. So what I'd like to do is pass those along to the panel, and then maybe we could follow up with email with responses to those. They must be having some bad weather. We heard the rain at the beginning of Christian's segment. But great session today. I think what we'll do is we can leave it there. And folks, if you, I want to make sure that I cover my final points here. Moody's Analytics, they've been a great partner to Experian on this Main Street report and these quarterly webinars. We've been doing this dedicated on a quarterly basis, at least for as long as I've been here. And this month it marks 8 years at Experian. So thanks very much to Moody's Analytics. More information about Moody's Analytics can of course be found at moodysanalytics.com. They've also got a fantastic podcast that I've been listening to. And then more information on Experian, of course, Experian.com/B2B. Check out our Business Insights Hub. There's lots of great thought leadership. We're putting a bunch of reports out there, bi-weekly reports, our Commercial Pulse report, in addition to the Main Street report. And I want to thank all of you for attending today. Stay tuned for a follow-up email from us. And we will be, of course, back next quarter with the Q2 Main Street report. And I want to wish everybody have a good day out there, folks. Thanks for coming.